Welcome into this week's edition of On the Spot. I'm Tony Mulvey, joined by Zach Strickland. Zach, how's it going?
Great.
So, today's not, well, we're going to talk about the LMI. It came out last Tuesday.
Right.
So just kind of getting a breakdown of what the boots on the ground members are seeing in the freight market, those logistics managers. We'll bring up the first chart, so kind of lay the land. The LMI is a diffusion index. Anything above 50 indicates expansion. Anything below 50 indicates contraction. Back above 50 and accelerating above 50. But I think there's reason maybe for pause of why this is above 50 for if you're a carrier or broker in the space. Maybe not the best thing, whereas if you're in the warehousing space, might not be so bad right now.
Yeah, I think you really have to break the LMI into components because we've had this huge divergence of kind of correlation between warehousing and transportation.
Yep.
And not just there, but also in the way that capacity is represented.
Yes.
Is very different. So you can have this push and pull on this index in aggregate that really doesn't tell you a clear, I think, story of the logistics space.
Yeah, so what better way to do than to break it down? And the first one, I think this is the one I look at the most because we talk about it. You saw retailers really talking about it in early 2022, realized that they had an inventory problem.
Right.
So looking at what the inventory costs are and the inventory levels, and we see inventory levels at 47.4, still in contraction, not really a surprise. I think what's interesting is the largest retailers have been able to reduce their inventory. I think it was Walmart in their latest quarter was down 17% year over year, Target down 5%. I may have those backwards, but either way, they've made reductions in inventory, but they can do that in ways that maybe smaller retailers aren't able to because one, they have the scale nationally to, hey, if we take a 10% reduction on TVs to move that inventory, it is easier or it's better for us overall than to sit there and hold inventory, especially when you look at costs. Inventory costs continue to rise. And I think that is a reason, one reason why they realized they had an issue and we've got to make changes.
Yeah, human nature is to overcorrect. And it's very hard to be precise with any of our actions, especially when we're talking about and the aggregate.
Yeah.
And Walmart, of course, has scale. Target has scale. They can't, it's really, really hard to target inventory levels to the precision, especially in a moving target environment, economic environment that we're in. So I think my takeaway here, my largest takeaway, especially for any transportation provider, is that inventories are still correcting. We're still moving down, but this is actually a good sign in the way that they're selling more than they're bringing in.
Yes.
So that means in the future state, there's the potential that they actually start ordering more goods, or at least in a more predictable manner.
Yeah, and I think the part that goes into that is what happens with the consumer. I think that's the kind of this guessing game.
That's the big unknown moving forward. I mean, economics are not great for the consumer.
Because, like you said, it kind of sets them up to order stuff in the future, but at this point, they're not going to order it if they know it's not going to move. Because again, costs are so high to hold inventory, and you can go into warehousing. I didn't bring it up today, but you can go in and look at warehouse prices and availability, and like that, it's just, there are constraints across the board, and it's expensive. And I think that's part of the reason why, one, that future order cycles may, I don't want to say change, but it's like there's so much unknown on the consumer front that they're not going to face the issues that they faced back in 2022.
They're hesitant. They're hesitant to do what they just did, which is overorder.
Exactly.
And that's why inventory levels continue to contract, is because they're still kind of hesitant. Now, when I say future, I don't know if that's 3 months, if that's 6 months.
Yeah, there
could be a year. I don't know. Until they start to feel more confident in what their consumers are going to do. And I don't think that we see any reason to think that the consumers are going to start ordering as more at least.
Yeah, especially when you look at the CPI that came out this morning, came in higher than expectations, but you look at real wages were negative again. And I think that's, so consumers' dollars aren't going as far as they were, and it's not keeping up with the rate of inflation to some extent, right? That's on a month-to-month basis. They are up slightly year over year, but it's not enough to go out there and spend willy-nilly, especially when you start looking at savings rates. so low that there's so many questions.
We're still dealing with the impacts of that pandemic era inflation.
Yes.
It may not be supply chain bottlenecks anymore, or the lack of, or the inflated demand, but we're still seeing the impacts. All these labor negotiation deals, that actually increases inflation over time. The federal funds rate increase actually increases inflation. The only purpose that they do that is to destroy demand. But it actually still inflates the price of things in the long run. So we are still flushing all of this stuff out in the inflationary figures, which means that the Fed could raise rates again.
It sure feels like that is on the table, and it would be a concern just because we've gone so far so fast that it's almost like it's not felt. The brunt of these increases hasn't really been felt, because when you think about how, like a credit card, for example, the interest rate, right? It's annual, and they break it down month to month. Well, if it's gone from 24 to 28, 29%, you may not necessarily feel that on a monthly basis, like those increases, because they're relatively small. But as over the course of the year, and it catches up, it'll eventually be felt, especially when you add in the fact that we have, over $1 trillion outstanding in credit card debt?
We've got an amazing amount of debt to deal with in the economy, and not just in America, but in the rest of the world. There's a ton of debt out there, and at some point that bill comes due. It's really up to the banks to figure out what that means.
Absolutely. Well, Zach, thank you so much for joining me on this week's edition of On the Spot. Right now, we'll take a quick break, but we'll be back with more FreightWaves Now.